And now let's bring you that big exclusive. Adrian Lim, Senior Investment Manager, Asian Equities at Aberdeen Standard Investments, in conversation with Nikunj. Let's go across.
I think there are pockets which are not working well and going through a short-term adjustment. I think you mentioned autos. That's real. You have the Bharat 6 standards being implemented over the next 2 quarters or so. There will be inventory issues. There will be stock clearance issues. There will also be an opportunity for some of these car makers to discount and to gain market share. So it will be an interesting, exciting time. But by no means does it mean that all sectors that require credit will continue to grow. We have large positions in our banking holdings, but because we think that over the longer term, some of these short-term blips will work its way out. What we try and do with our banking holdings is to look for franchises that have a good reputation for managing credit profiles, credit control throughout the credit cycles, but also banks and financial institutions that have good distribution capabilities and a strong reputation for managing capital well. And if you identify those stocks and hold them through the medium term and long term, you should come off better. And that's the position we hold within the banking and financial space.
Specifically talk about pockets. You talked about slowdown in auto. The stocks or the companies where you invested in, Maruti, Hero MotoCorp, Bosch and Castrol, they are right on the face of disruption. The fortunes for Bosch could change if electric vehicles increase. Maruti could see a punch on its sales if there is a challenge with becoming if there is a challenge in slowdown. So are you committed to your auto holdings in India for next 3-5 years, or you could revisit them in a substantial manner?
Well, we like to hold our positions for a long time, but that doesn't mean that we don't monitor and pay attention to what they do. You mentioned 4 very good companies. I think that they have a place in any portfolio where you want a diversified exposure into the Indian market. And I think these are companies that will do well. The electric vehicle story is something that will take some time to play out. You mentioned destruction, face of destruction. I think that's exaggerated. We will see changes in the drivetrain. We will see changes in the way the energy is managed, but it will not. It's not a business that will disappear overnight. What we do is that we control our exposure by not having too much in the stocks that we think are either too pricey or where the earnings forecast is uncertain over the medium term and long term. But stocks like Hero, stocks like Bosch will continue to form the core of our auto exposure in India.
Okay, I'm just spending some time on autos, Adrian, because you're in a position where you can take an India view based on your global experience. So given what is happening to the auto sector globally, your view in India is that the existing auto companies will not face the heat of disruption.
I don't think you can say that autos around the world will face the heat of destruction. I think the auto cycle is currently weak, but there are some very good companies globally that will be able to withstand that challenge, technology challenge, and that demand challenge as well. It is by no means clear how EV would pan out. There are 4 or 5 competing technologies, each of which have credible cases for being viable options going forward for the mass market. And there are some considerable challenges for each of these technologies as well. So in the shakeout, we will see good companies survive and continue to thrive, but you do need to be very selective about what you like. I think the added advantage about Indian autos is that stocks like Maruti, Hero are very much buffered to some extent from the developments globally because they cater to the local Indian market, which have slightly different demands as well. It's not just technology, it's not just emissions, it's also affordability, it's also styling, it's also distribution. So there are many things that come into play. And we think that these positions in these stocks that we talked about are measured bets that should do well in the long term.
Adrian, whereas the heart of your portfolio is financials, within that looks like you are moving away from owning private banks. A name like SBI Life Insurance has entered your portfolio. You have exposure to Max Financial Services. Aditya Birla Capital has made its space. So are you looking at changing your, not weightage, but the companies you own within the financial sector?
Well, there are some of these changes, but if you look at the relative weights, you would see that the cornerstone positions in our financial services remain stocks like HDFC Bank, Kotak Mahindra. These form the core weights within the portfolio. SBI Life is interesting, but it's not really purely PSU as well. SBI, the State Bank of India, has incubated quite a few of these entities, which are being run on a more commercial basis when it comes down to business plans and expansions, when it comes down to performance rewards for its employees. And I think they have demonstrated very clearly that they can go toe-to-toe with the private sector financial institutions. So it's clear that we do need to keep an open mind. It's not just about PSUs versus private. There are many nuances within the Indian market. We need to keep an open mind and not be too simplistic about the way we categorize and we see companies. I think there is good growth opportunities for the life insurance business, and SBI Life is well positioned to be one of the best within the Indian life insurance sector. The other holdings that you talked about, Max and Aditya, are relatively small positions within the fund.
But Adrian, a purist would say that HDFC Bank, Kotak Mahindra Bank, they have given good, solid CAGR returns for 15, 16 years in a row. They are expensive stocks to own. Can they continue to grow at historic rates because of base? And can these stocks give historic returns what they've given in the last 15 years? What is your stand on that?
Well, you look at history and it gives you some sense of certain patterns, but we don't go into a stock expecting to see historic numbers replicate themselves or repeat themselves over the next 15 years. The landscape is changing. There are challenges now that they didn't have to contend with 15 years back. There are challenges now that keep repeating themselves, and they have had the opportunity to meet those challenges again and again. I think in those three banks, three financial institutions, what is important is that we look at quite a few things when we weigh up our banking holdings. We look at the strength and the competence level of the management teams. We look at the resilience of the business models that each of these financial institutions provide. We like the reputation of these institutions. We like the funding structure. We also like the fact that they continue to grow in spite of the fact that there are a lot of headwinds within the credit space in India. As you know, since Q3 last year, the market has been anxious about financial institutions, but these companies continue to post double-digit loan book growth with minimal signs of margin stress and minimal signs of NPL expansion. So we like what we see, and they will continue to form the core of what we hold within the financial space. Now, we don't sit back and forget about these stocks. Every quarter, every 6 months, every year gives us a chance to revisit the investment hypothesis that we hold, and we will do that. We will compare them against their peers. It's a competitive landscape, and it's a challenging landscape, and although they have done well in the past and in the present, we make no assumptions that they will guarantee outperformance in the future. But that's the challenge, and that's the task of what we have to do, to evaluate them periodically, regularly, to see that they continue to have the components that will deliver good growth over the medium and long term.
So when you say evaluate private banks, what are the factors and ratios which you monitor, which give you the comfort that private banks are going in the right direction? Do you look at spreads? Do you look at NIMs? Do you look at credit growth? I'm asking you for a bit of a trade secret here, I guess, but let's talk about it. Why not?
No, it's not. It's not secret at all. I think all those ratios that you talked about fall into any textbook knowledge of analyzing banking stocks. I think it depends on how you weight them and what time horizon you look at them. That might be slightly different for each investor. Net interest margins is important. Non-performing loans numbers, gross and net, are important numbers. Credit growth are important numbers, but they are not the only thing. And it's a mix of all these things that come to bear when we make that decision. I think we shared quite a bit. It's the team that we look out for, the business model that we look out for, and then to make sure that the financials replicate what the strategy and the managers represent of the institution, and all those things weigh heavily onto the assessment of these stocks.
You also have a large exposure to Nestle, HUL, ITC, and even Jyoti Labs, a relatively small position. Now, the follow-up question here is that A, they are expensive, B, the base effect has kicked in, and C, the Indian consumer sector right now is slowing down. How would you defend this?
Well, they have always been expensive. They have been expensive because the consumer staple space in India is priced to a high level. We like these franchises. These are stocks, and they have a built-in resilience because of the brand strength of what they put on the shelves and the distribution strength of what they put on the shelves that make their earnings numbers resilient. But the valuations, you're right, are pricey, which means that we have sizable amounts, but we would probably have more if the valuations were cheaper. But this is what we're comfortable with at this point in time. Looking across the universe, the stock picking universe, I think we're comfortable with the relative weights we have in this sector.
The outlier in your portfolio, some would argue, is cement. Within cement also you own the big names here. That's largely because you're betting on India. But cement, frankly, Adrian, is a function of economic growth. And that's where the puzzle is, that we've been hoping, and now some are praying, that India should recover and earnings should come back, but it's not happening.
Yeah, the cement story has taken longer to play out than we hoped. But you can see that when you travel across India, the needs are still there. And it will come back, and that's what we're positioned for. We are positioned not for the next quarter or the next 2 quarters. We have a 3 to 5 year time frame in mind. And we think that during that period of time, our cement exposure should come good. We are continuing to see sensible cost management policies, sensible capacity optimization policies, and our cement stocks continue to, not rest on their laurels, but continue to improve their operations until a time when utilization rates will pick up to strong levels again.
You've been a long-term believer in Infosys and the corporate governance they followed. What do you make of the whistleblower complaint there? Could that and could that make a long-term investor like you nervous about Infosys?
Yeah, I mean, it makes us think every time a whistleblower pops up. It makes us think across our portfolio. It's not just in India, it's not just in Infosys. It's something that we take seriously and we pay attention to. We will wait until we get further clarity. It really depends. We have had some conversations with the company and we have had some assurances, so we will take it from there. But yes, it is a concern. But we also know that it is a very noisy environment at the moment. And we want to make sure we don't overreact to things that pop up. So we will take a measured view, but it's something we take seriously.
Adrian, the charm for India was that India has some fantastic companies with high return ratios and great corporate governance. Unfortunately, there have been some corporate governance slippages, and some major corporates have done that. Could that make you nervous? Could that have an impact on the India aggregate premium? Because what India commanded was quality and high return ratio companies. And if that is compromised for a market where earnings are not there, P multiples could contract.
They could contract. P multiples could contract, or your earnings base could expand because you're in a difficult period in the cycle where the economy is not firing on all cylinders. There are various challenges across different sectors. There's underutilization because of overbuilt capacity in certain other sectors. So yes, a few things could happen. The PE numbers could come down, but the earnings base could increase as well, making the PEs deceptively expensive. I think when you talk about PE premiums for India as a market as a whole, it's not just about the quality of governance, it's also about the quality of the underlying growth within the system, is the level of under-penetration within quite a few of these sectors, and is the multi-generation story in many verticals and many sectors. We're not talking about a growth cycle that will last 1 or 2 years. We are talking about a growth cycle that will last a generation or two. And that's the ultimate attraction of a marketplace and economy like India. I think governance is a tricky one to attribute the premium to. We don't take it for granted that every company that comes out of a particular market has a particularly high or low governance. You keep an open mind, and then you pay attention to what the promoters do. You pay attention to the related party transactions that get done. You pay attention to how directors and senior management team are evaluated and paid and rewarded. And all those things come to weigh in on what we call governance. So it is very much a case-by-case basis. We see good companies in markets that reputably have bad governance or poor governance, and we see bad companies in countries that have good governance. So I wouldn't take it on face value.
Aggregate level, Adrian, what is your India positioning within allocation? Are you overweight, marginally underweight? Where do you stand there?
We are overweight India. It's been a relatively volatile market the last 3 years. So there are periods of time when we've taken profit, and there are periods of time that we built up. We're currently overweight in India, but over those 3 years, we have always been overweight in India within our regional portfolios.
I remember talking to Martin once, and 2 years ago, Martin said that, look, we like India, but we think China offers better value, and we're happy to revisit Chinese stocks. Could that be a stance, or you think right now you could remain overweight for India for next 1.5 years?
Well, we have been expanding our weight in China. I think the interesting thing is that there is no... it depends on what portfolio you're talking about. When you look at Asia as a whole, you cannot ignore India or China or Indonesia or Vietnam or Southeast Asia. There are pockets in each of these markets that are attractive. You can't ignore Korea and Taiwan as well. It is not a case of India versus China. I think given the choice of buying and picking the best stocks we can in Asia, you will get good companies from these two countries. Now, the interesting thing for us is that over the last 2-3 years, we have been expanding the Chinese exposure that we have in our regional portfolio, but that's not explicitly at the expense of India. But just because we've been doing that for the last 3 years doesn't mean we will continue to do that for the next 3 years. These are stock-specific driven decisions where we compare stocks across sectors, across different markets, and we don't take a top-down approach. Our decision-making is very much built on bottom-up stock analysis and the relative attractions of each stock, regardless of which markets they operate in.
Adrian, I know you don't track liquidity, but we both know that liquidity plays a very large role, at least in the medium term. 6 to 1 year, liquidity decides which way stock prices will move. What is your sense on the way how emerging market flows have behaved? What has been your experience in emerging market outflows and inflows with your clients?
We've seen quite a lot of volatility within our own portfolio. It has been modest, relatively modest. We've been able to manage that liquidity reasonably well, but it's impossible to predict. A lot of this is very much dependent on sentiment, and our flows, I do not think, are representative of the wider market flows all the time. It comes and it goes, so I wouldn't venture to predict where liquidity would be 6 months from now.
The anchoring move, essentially, Adrian, has always come because of central banks. When central banks increase rates, liquidity moves away. When central banks decrease rates like they've done this year, liquidity comes back. So for next couple of months, what could be that benchmark or that anchor which will decide which way the cookie is going to crumble?
Well, you know more than me. You have the answer, so maybe you should weigh in. I can't tell.
If you have to summarize our today's interaction, Adrian, can I say that you remain committed, you are bullish, and you're reasonably confident about India growth story and the portfolio companies where you've invested in? You don't see there is a problem because of slowdown?
Oh, we see challenges because of the slowdown, but called to make a relative bet, we think that the Indian companies that we hold are in good position to take advantage of some of these challenges. But there are challenges within the slowdown, not just in India, but across the region and the world as well.
I have to ask you a question which may not be a very happy memory for you, but I remember tracking as member of a press, which is that you had a large exposure in BPCL. It was not a very profitable trade for you, but now BPCL is on the block. If a company like BPCL or Container Corporation, which you've owned in the past, is privatized, will you look at it?
Well, I need to correct you on a few things here. BPCL was a decent investment for us, but it's something that we have not held for more than 10 years. Container Corporation, we continue to hold. I take it that your question is that if a state-owned enterprise becomes available for a greater free float, whether we would participate. I think that's something that we are always open to. So we do need to weigh the benefits and the cost of those things relative to what else is available out in the market. I think India has enough choice that an additional placement will not significantly change the options and the decision making that we need to make. But we'll always be open to placements like that and trying to understand and educate ourselves and know better of what a relatively interesting placement could be like.
Well, Adrian, it's so fantastic to have you back, and thank you for joining us, and thank you for patiently answering all our queries.
Okay, thank you.